Ma'am, last class also it was hands-on only, right? The Excel sheet one, which we did.
Yes. Were you there?
Yes. Please.
Nikhil, you are not there, I think. You are there, Nikhil?
Yes, ma'am, I was there.
Okay. So we'll start from there. Wherever you have stopped, if you are there, then fine. Then I need not repeat it all. Okay. So another thing is throughout we'll be working out. Okay. So we'll be doing some work. So you be ready with your Excel or calculator and all. So last class, what we have done is we started from here. Okay. So concept of risk and return. We showed you how to calculate return on a single asset. For example, suppose the asset is a share of a company. Okay. So we are calculating how we can calculate the return of a single asset. In this case, what is happening? This you are there, no, Nikhil? Last class, we have calculated this return.
Yes, ma'am. Yes, ma'am.
Okay. So all this we have done. Dividend calculation, then your capital gain and losses. Yes or no, Nikhil?
Yes, ma'am.
Okay. So we move on till here we have done. So I won't repeat this. So rate of return calculated on share basis, you know, it is the summation of your dividend yield and your capital gain yield. Now, what is the risk involved in this? This we are calculating with the term which is known as your standard deviation and variance. Okay. So we'll go from there. Another thing is we have calculated the average rate of return. Last class, the hand-on session I gave you, you calculated the ARR. This we have done. Yes or no? We calculated the ARR.
Yes, ma'am.
And the result you got was this. This was the result we got for the various years. These were the returns you got. From here, we'll proceed. And the last class, I mentioned you about the risk and return. So for any asset, once you get their rate of return, okay, so you can now calculate how much risk is involved. Now, for the risk part, you have to calculate it in terms of variance and standard deviation. Now, how to calculate the variance and standard deviation? From here, you write calculation of variation. Sorry, calculation of variance. So once you write the steps, we'll go to take on the session. Okay. So first is calculate the average rate of return, which you have done in the last class. The first step is you are going to calculate that the average rate of return. Second step, where your average, the average rate of return is calculated with this formula, which is your, you can see the return over the various years, your R1, R2 plus Rn divided by 10, which is the number of years. So you get the average rate of return. Second step is you take the deviation of your returns from the average rate of return. This is your second step. Have you written?
It's writing, ma'am.
Okay. Then written or writing? What you are saying?
Ma'am, writing.
Writing. Okay. So rather what I'll do is I'll go to the board and make the thing little bit less easier for you. So what we do is go to the board now to show you the steps you are going to use here to how to make it little bit easier. So steps to calculate variance and standard deviation. And remember, both this standard deviation and variance are used to calculate your risk, return risk, how much risky the asset is. Okay. So the first step is number one, calculate the ARR. So calculate the average rate of return. Why the average rate of return? Because your return for any year how you measure how much risk is there. You will see what is the deviation of your return every year from your average rate of return. That's why the ARI is calculated, because your risk is how much your current return is deviating from this average rate of return every year. Okay. So first is calculate the ARR, or it is also written as R constant. So where your R constant or your average rate of return is given as your summation of the returns are true for the various years up to Rn whole divided by, this is your n is the number of observation. So this is your 1 by n, and your this is your summation of these RT values. Okay, where RT is changing from 1 to n. Your T is the time period. Remember, your T is the time period in which the return is occurring. Second step is you calculate the deviation. Calculate the deviation from the ARR. Deviation of the returns. Simply take these steps to make it more easy. Of the returns, okay, from average rate of return. We calculate this deviation from the average rate of return. So this is your R minus your average rate of return is this. Okay. Third is square. Square this deviation. Square the deviation, which is you will take R minus R dash, sorry, this is not summation. Take the square. Take the square of it. Okay. Now have you written these 3 steps?
Yes, ma'am.
Okay. So now fourth step is your variance. So your variance, which is given as your sigma square, is given as summation of this square deviation. R minus your average rate of return square. You have taken their deviation whole divided by. Okay. This is n minus 1. Here I'll just give a short note that if you take sample, okay, if you are taking sample, then this term, denominator is the n minus 1. You divided it with n minus 1. But if you are working on population, that means the whole population of the respondent you have taken, then you have to divide it with n. Divide it with n, not n minus 1. But you don't need it, because we'll always be working on sample. You will have no work with the population. So your work will always be with the sample. So your formula will be n minus 1. And after you calculate this, your standard deviation. Standard deviation is simply the square root of the variance. Standard deviation, which is given as sigma, is simply taken as the square root of the variance. Okay. That means it is the square root of your sigma square. Sigma square, which is your sigma. Is your sigma. That means it is the square root of this term. Or you can also take it as the square root of your variance term, which is your R minus the square. This is n minus 1. Summation T changing from 1 to n. Have you done? Have you written?
No, ma'am. Just a minute.
Okay, completed. Then we'll go to work on the Excel.
Done, ma'am.
Okay, so now what we do is go and open the Excel file I have given you. So we'll go and open the Excel file. you will open your file number. This we have calculated second assignment. This is about lot many shares. So you open file number 1 only. Open file number 1. Have you opened file number 1?
Yes, ma'am.
So you got this written 10.8. I have opened this worksheet to show what we have calculated in the last class. So you can see this was the dividend per share given to you. So you calculated the dividend yield, which is
Ma'am,
your, yes,
ma'am, your screen is showing just the whiteboard. Ma'am, your screen is showing just the whiteboard.
okay. Now is it visible?
Yes, ma'am, now it is visible.
Okay, now, so you see, last class we calculated this. You were given this, if you open file number 1, Excel sheet, you will see you are given this HUL yearly return data, which is your dividend per share, then share price. That means your column 2 was given to you and column 4 was given to you. Rest you calculated. You can see this red I'm doing is you calculated it, isn't it? So first you calculated the dividend yield. So how is the dividend yield calculated? Simply what you have done is this divided with the price of the share of the previous year. So in this case, your price D4, you can see 206. Similarly, for the next year, your price share, this becomes your the next year share price becomes your denominator. So each year dividend per share you are dividing with the share prices of the previous year, and this is how you have got the dividend yield. Capital gain yield, I've written the formula, you already know. It is the price of the share in the current year minus previous year divided by previous year. So that's why you're leaving the first one blank. You're calculating from here. So it is your 223.65 minus 206 divided by 206.35. Okay. So this is how you have got the capital end yield. You know that whenever you're investing in a share, you get two type of returns. One is your dividend yield and another is your capital gain yield. Okay. I told you in the last class that dividend part is very much secured. You can see the return from the dividend yield. You can understand from here. 2.42, 2.463, very less fluctuation in the dividend yield. But if you see the capital gain yield, there is a huge fluctuation. Okay. And what is this, whatever fluctuation you get in your return is because of this capital gain yield, because this is subject to your market risk. It can be higher. You can see some year it is negative, some year it is positive, some year it is very much near to zero. So because this is completely volatile, it is depending on the market share. So when you are getting the return from your asset, single asset, a particular share you have invested, so your one part is completely secure, you're getting a constant yield. Another part of that same share is completely volatile. It's depending on the capital gain. And when you are summing up your dividend yield with the capital gain, you get how much is the return on this. Now, today we are going to calculate how much is the risk involved. That means for the risk, what you are going to do is how much it is debited from your average return. Are you understanding? So what is the risk involved? Risk involved is how much this return. For example, here your return is from 10.81 in 2001 and changing every year. Okay, so how much this has changed from the average return. So first step is you calculate the average return. So already you have done in the last class. What is the average return you have got? How much average return you have got?
Ma'am, 10.49.
No, you just do it here. F5. It is the summation of this F5 to leave the first one blank. Okay. Because we are taking the average, if you are taking the 0th year, you leave the first year blank and then take the sum. See, it is 11.44.
Yes, ma'am, it is 11.44.
11.44. So you got the average return from 11.44. So from here, We'll now proceed to calculate the risk involved to this return. I said this return, you can see it is fluctuating so much. First year, you have a 10.8% return positive. Second year, it is dropping to minus 16. So there is high volatility in this return. So when you are investing, how can you find how much is the risk involved? For that, you have to calculate your standard deviation and variance. So I'll just go back. Standard deviation and variance, I gave you the formula, no? So we can go for the calculation. So let us go for calculate the variance and this standard deviation of this. So what we'll do is complete first take the only we need only this returns, because from this returns we are going to calculate. So what you do is copy the year and the average rate of return to the next page. To the next sheet. Are you doing on in Excel? Or where are you doing? Are you doing on Excel or what?
Ma'am, can you repeat?
I'm
I was not
asking
able
that
to.
are you doing it on Excel or where how you are doing? Laptop only you are doing, no?
Yes, ma'am.
Okay, so let us
I'm doing
calculate.
it. Yeah.
So let us calculate. So we'll calculate. You can see my Excel sheet, okay? So calculate the risk. So when you are talking about risk, that means you are going to calculate. That means you are going to calculate the variance and the standard deviation. And what they show how much your return are fluctuating from your average return every year. So your average return is giving you the average of the return every year. So how much are they fluctuating from that? So the first step, what you are going to do is calculate the average rate of return. So calculate the average rate of return. So what you can do is simply put a equal to sign here and take the summation or average. You can just choose the function and just drag and you get your answer 11.4. Did you all? Did you all get this?
Yes, ma'am.
And you can just lessen the number of decimals here. You can see if you are doing it in Excel, you can just lessen the number of decimals by simply clicking here in your right side. Decrease the decimal. So your decimal is reduced 11.44. So the next step is, what is the next step is you will take the deviation. See your steps you have just written. Okay, this is your returns value R. Okay, so these are your returns value, which is your R. So what you are going to do is you are going to take the deviation from the average rate of return. So this is your R minus ARR. What is your ARR? Your ARR is this 11.44 you got. Okay. So simply you will take the deviation of this from this. So calculate. You can just leave out the first year. Okay. So you take the deviation from here. So don't calculate for the first year. We leave it as blank. Okay. So if you calculate, this is equal to, we don't put a minus sign blank here. It is taking as minus sign. You simply start the calculation from the second year. So this is your 10.81 minus your 11.44. Then this is your 16.28 minus 11.44. This is what you are doing. Are you getting the same answer?
Yes, ma'am.
You can also get it by dragging. Simply the formula gets copied. Mine is for some of the cells it is not getting copied. I don't know, some issues, so I have to do it. So this is minus. So first you have taken the deviation from the average return of every return each year. How much it is deviating from the average return. Then what is the next step? Giriraj? I don't know who is listening or not.
Yes, ma'am. Yes,
What
ma'am.
is the next step? What we will do after you take the deviation from this? What is the next step? Or the standard deviation?
Will
You are going to take the square. Isn't it? Square this. So this is, you have taken the deviation every year return from the average deviation. Then third step is you are going to take the square. So square this, which is your R minus ARR. That means you simply what you do is put equal to sign, then choose this, choose your power button, power to the 2, raise to the power 2 and enter. And simply drag it. You get your answer. Okay. Do you all get the answer? So what is your variance? Variance is what you are going to do for variance. First, you need this summation of this square deviation. So you have to take the summation, take the sum. So you can just choose sum button and click and you get the sum. You can do in your calculator as well. Did you get this answer? This is the sum value. 467.61. Let me know if you have got it. Got Nikhil, whoever is doing.
Just a second, ma'am. My sheet got closed. I'm reopening it and doing it.
Remember, I'm doing it in Excel so that I can do it faster. You can simply do it in calculator because in the exam you won't do it in your. Yes, you can do it in your Excel as well in the exam also. So you can practice it on Excel, on calculator, anything. These are all simple sums. So this small lot only will be given so that you will be easily doing it in your calculator in the exam as well. So you should get this answer 4671. If anybody is not there, you can ask me. So what is the first step? First, last class we have calculated the ARR, which is your simply dividend rate plus your capital gain yield. Today we are calculating the risk involved. Risk is interpreted in terms of variance and standard deviation. So what is the first step? First step is you simply calculate the ARR, then take the deviation of the returns every year from the ARR. In this case, it is 11.4. That means deviation of every return from 11.44. After that, you are squaring it. So square of the first one, 0.63 square, 27.71 square. This we have taken the square. And then we have taken the summation. Whatever steps you have written, we have followed. Yes or no? What is the answer? Fast. Anybody who has got? You got it or not? Are you doing, Nikhil, Anurag?
Yes, ma'am.
Did you get this answer?
Ma'am, I've gotten the first one. I'm doing the square of R minus ARR.
Okay, then you just square it. If you have reached this 4671, tell me.
Yes, ma'am.
Got 4671.
Ma'am, I got 4, 5 something. I think I made a mistake.
So anyhow, then you just write 4671. You should get this exact answer. For this values, you should get this answer. Okay. Then what is the variance? Variance,
Okay.
variance, you remember, variance is the sum of this. This sum divided by n minus 1. N is how much here? You are living 2000. So living 2000, how many years are there? This is how many years you see? It will just simply drag from 2001 to 2011. It is 11 years. So your variance is what? summation of this divided by n minus 1. Your n minus 1 is 11 minus 1, which is your 10. So you get the variance as 467.16. Your variance is 467.16. Okay. How to calculate the risk standard deviation? How much is the deviation? Standard deviation, what you do is simply take the square root of this variance. It is equal to, you have your square root function here in Excel. Simply select your variance term, click OK. So your variance is 21.61. That means your every year return has a risk of deviating at 21.61% from the average return. It may be above or below. It may deviate in the positive way or negative way, but the variability is to a range of 21.6. It is a very volatile or risky asset. Okay, if your asset crosses more than 5%, they are very, very riskier assets. You can see returns are also high. You just see it is very risky asset because 21.6 is the variation from the average return. So it may, your whatever return you are getting every year, it may fall by 21%. But it can also rise by 21% because you can see, for example, 2002, it is minus 16%. But if you see 2005, it is 40% returns. Similarly, 2011, it is 46% returns. So your share prices have increased to that amount. So huge variability is there. So either way, you may benefit depending upon how long you are holding the share. Have you all got these two answers?
Yes, ma'am.
Okay. So
Yes, ma'am.
let us proceed. You take down these two answers, tally it after the class again. Okay. Tally it after the class. So this worksheet is over. So what we are going to do is again go back to our PPT first. Go on doing. Well, if you are not able to cope up, simply keep it and practice it just after the class. That will also do. So can you see the PPT again? Just tell me. Can you see
Yes,
the?
ma'am.
Okay. So we move on. So this is calculation of standard deviation. Already you have done. It is simply the square root of the variance. So let us now calculate the variance and standard deviation of the Hindustan United Liver's rate of return you have calculated. So your variance is 467.16 and standard deviation is 21.61. So what is the conclusion? Conclusion is that if this return is showing wide fluctuation and you cannot predict with certainty about the future return. So it depends whether you're going to invest or not. It depends upon your risk attitude of that investor. Some investors are very risk loving because you can see returns are also very high. In case the economy prospers, your return is also very high and vice versa. So it depends upon what type of investor the person is. Now we'll have a hands-on session in the following exam. In the next exam, you will be having such a data calculation for any one or two asset. Okay, just we'll have a hands-on session on this. So you are given the data of major financial instrument from 1994 to 2013. Compute the risk and return involved in this investment and interpret the result. So we given you to you some assets are there. Their return information is there. You have to show or calculate which asset is good for your investment. Okay, then we'll see what type of investor the person is and decide about which asset should he invest. Now, what you have to tell me is, I'm selecting the file. You just tell me whether you can see the file or not. Go to second, hands-on second.
Yes, ma'am.
Can you see my Excel file?
Yes, ma'am.
Okay, now you see, I've given you now different, there we calculated only on one share. But here now I have given you a full portfolio. I've given you a stock return. These are all different type of investment you can make. I've given you the stock return. I've given you treasury bill. You can understand this is a bond, 91 days treasury bill. Okay, call money, market instrument. Then this is a government bond, LT government bond. I have given you a full portfolio, different assets where you can invest. Your work is you to calculate the which asset has how much risk and variability. You calculate the risk and variance of each asset. Calculate. So calculate the risk involved in each. Calculate the risk involved in each. Okay. So that means you have to calculate the variance and standard deviation. Those who are not there in the last class, this will also be a practice for if you have not there in the last class. Remember here, what we are doing is there is no probabilities. So what we are doing is we are simply taking the absolute return of the assets and calculating. Okay. So after you do this session, we'll enter into expected return. That means if there is, like for example, suddenly COVID was there, so some risk element is involved in the economy, uncertainty is there in the economy, how to take care of that, and then put that information in your calculation. Okay, so now we'll do it without any uncertainty involved. So same way you proceed. So first let us do for the stock return. Each one you have to do it separately, isn't it? So what you do is I'm just copying this stock return. Okay, I just copy this stock return and take it to the next data sheet. Let me take it here and paste. Let me calculate this first. Okay. Are you all looking?
Yes, ma'am.
Okay, now Yashasha, tell me what is the first step? What we have to do? What is the first step? What we have to do in the first step? What we'll do? Are you listening? Are you listening or not? Others? What is the first step we have to do? Calculate the average rate of return. So calculate the average rate of return. So what is the average rate of return? Simply what you do is take the summation. So your average rate of return is you take the average. You can just select the average function. Okay. And then select this informations. Select this info. Simply have to drag. So you get your values. Sorry. So it is your so how much did you get? Average rate of return.
35.57.
35.57. Next step is you will take the deviation. So your next step is your R minus the ARR. So you have to take the deviation of each year. So let us do. So this is equal to your first year return minus how much it is? 35.57. So 35.57. Putting some dollar sign also solves the matter. So if you can do it, you can do it. Wherever the minus sign is coming, there only it is getting some issues. This session will get log out in 4 minutes. Again, we'll join back. Are you doing the Nikhil?
Yes, ma'am.
Okay. Simply go on subtracting from the average rate of return.
Ma'am, the average rate of return is showing 16.34.
16.34.
Ma'am, here in the Excel sheet, that negative sign is, it's not negative sign, it is showing it as a dash instead of a negative sign or
That is the
subtraction symbol.
problem. Yes. And that is why I have to show this. Individually, I have to give the comment.
And that is why the average also is being given wrong, I think. Like 35.57, if it is taken as dash, if we convert it as a negative sign, it gives 16.34.
No, Nikhil. For the first one, it is 35.57 only.
Okay, ma'am.
Okay. For the first one, it is 35.57. It's correct one. Then you take the deviation. And when you are squaring, then square it. When you are squaring the deviation, can you see this Excel sheet of mine?
Yes, ma'am.
Okay, so if you are just squaring the deviation, or squared the deviation, your answer is this 31,119. This is the answer. Okay. So if you are getting this, only the deviation part, when you are subtracting it from 35.57, it is showing some problem because the negative signs are there. So for the variance, what you are doing is you are simply dividing this with how many years and minus 1. This session will get log out. Then we will join after 7 to 8 minutes. Okay.
Okay, ma'am.
So by that time you calculate this. Okay. You calculate this and the 91% stock. So after we join back, we'll just proceed. And no more calculation for this we'll do. We'll go to the next step. So here
Okay,
is
ma'am.
the 20 years. 20 years means for the variance you simply divided it with 19.